Hi, this is Jeffrey Kerr, Kerr Financial Group, and today is May 6th, 2022. And just what a historic week, on top of historic years and all the developments over the last 5 years or longer. And this week with the Supreme Court decision being leaked, just an incredible development. And beside the controversy around the decision, what's the motivation behind the leak? I think it's an important point. Plus, also, finding out who did it and like that. But just, what's the motivation? What's the why did they do that, and what do they expect to do? Secondly, things like Elon Musk taking over Twitter. It just changes the dynamic of the social media and communication that we're so used to. And I think that's going to be an interesting development. Of course, you've got the ongoing tragedy of Ukraine and Russia conflict as well. Within the financial markets, history, the Fed raised rates on Wednesday 50 basis points. And yes, they've done even larger increases in the past, and but recently they've not moved to that extreme, and so I think it's pretty interesting that they've done that, as well as signaled 50 more basis points in June, 50 more basis points in July. I'm not sure they're going to be able to do that, but we'll see. And and in association with the Fed announcement was the incredible volatility in the stock market on Wednesday, huge rally afterwards. As an aside, it's easy to associate that rally with the Fed decision as it coincided, timing wise. But one of my services suggested that the setup was and options and derivatives that expired on Wednesday, that same day, that afternoon, were lopsided and contributed, or also caused the whole move more so than the news of the Fed. Now I'm not sure I fully understand how those the trade and the risk reduction on the dealers and the traders and like that work, but it's an interesting that this whole that move on Wednesday was more, much different from what the Fed's announcement and reaction to that. And secondly, the next day, yesterday, we're down 1,000 points in the Dow in just a very weak market. So I think that the market volatility and the bond market, going up in yield, down in price has been a recent development that's pretty important and pretty historic as well. But today, I really want to talk about the Fed. Not only the decision to raise the interest rates. I mean, they announced that. They announced the next two, and the Wall Street houses expect another eight increases, eight quarter point increases. So I'm not sure they'll get that done. I just think that the market may react and like that. But the Fed, has come out and said they're going to do this, and the message behind that, I think, was it pertains to not only the economy in our lives, but to the markets, is the Fed's no longer on the side of the markets. This is a change that's been going, and it's a change from 14 years of being on the side. In 2008, with a great financial crisis and mortgage meltdown, that the Fed has been on the side of the markets, both stock and bond markets, through quantitative easing policies and various strategies and mechanisms and like that they've employed to help support asset prices in the markets. Well, it seems like that's no longer the case, and I'm going to attach a video from Bill Dudley, former high-ranking Fed official, to this email. I encourage you to take a look at it. It's an interview, April 6th, on Bloomberg, where he had written an op-ed on Bloomberg, calling, pointing out that the Fed is okay with the stock market decline now. I mean, Dudley specifically says that. Listen closely to the video, and it says that the Fed is okay with asset prices coming down, which again a huge change. And I think the point of it is, the Fed saying, hey, they got to fight inflation, and certainly that is one of the things they should be doing, but I'm just not sure they're going to be able to do it given all the different cross currents and dynamics in the global economy. So and a lot of the chatter has been about whether the Fed comes to the rescue the middle class and fixed income people by fighting inflation, or does he rescue Wall Street once again, like the Fed has done in the past? Powell did it in 18, but certainly in the past, Bernanke and Yellen came to the rescue of Wall Street. So what happens this time if Wall Street starts reacting negatively to these increases, and but they stay the course of trying to fight inflation, and that may break the economy too. So you've got a case where the middle class fixed income are getting killed by inflation, and then the elites are getting hammered by deflation of financial assets, housing, and like that. If it comes to that. So maybe they can walk that fine line, maybe they can pull it off. But boy, I think there's some real risks, and I think the Bill Dudley thing is something to keep in mind, that the Fed probably not on our side anymore in terms of being bullish to the markets. So the recap of where the major averages closed yesterday on May 5. The Dow year to date down 9.2%, S&P down 13% year to date. Nasdaq is the worst, down 21.3%, and the Russell's down 16.7. So I, again, wanted to get this out. Please reach out to me, email, call, text, whatever, if you have questions or comments on this important topic. And encourage you to listen to the Bill Dudley thing, listen carefully because the message is there. Thank you for listening, and we'll be back soon. Thank you. Goodbye.